From the morning reading, JP Morgan, Citibank, SPX give back opening gains. The SPX closes slightly higher. 5 of 10 sectors moved higher on Friday. XLF, XLK, and XLB were the strongest sectors, while XLV was the weakest sector. Oil futures rose 43 cents to close at 50.44. For the week ended October 14th, 3 of 10 sectors moved higher. XLU 1.34%, XLRE, the new real estate sector, 1.22%, and XLP was just above scratch. In terms of breadth, it weakened compared to the prior session, that led 1516 to 1494 on the New York Stock Exchange, and decliners led 1441 to 1350 on the Nasdaq. So quite mixed there with the breadth readings. In other morning reading, we have, after reversing on Thursday, the E-mini ran into a no demand on Friday. It looks like the election uncertainty is causing big money to sit out on the sidelines rather than buy into the next rally. On the highest time frame tick charts, we've had a low risk entry point short. Confirmation would be a drop below 21.24. Closing up above 21.34 would probably negate the signal. While we've been sitting in consolidation since mid-September, we're likely due for some kind of trending move. Watch the euro and the European markets closely when we open up on Monday. They may be the tell. Also in the morning reading, it's been a long time since breadth has been oversold. For breadth, we've been referring to the 10-day average on the New York Stock Exchange up volume ratio, which hasn't been below 40% since January. That streak of 9 months is the longest since 2004 and one of the most extreme in 50 years. When prior streaks ended, it was not a particularly good sign that it's a time to buy or sell, actually. Somebody likes the banks. Traders in the RightX family of the mutual funds have quintupled the amount of money bet on a rise in banking stocks in recent weeks. When those traders have bet this much money on banks in the past, financial stocks have taken a bit of a hit. Also in the morning reading, our S&P 500 snapshot, a flat finish on Friday. Before the opening bell, the stage was set for a Friday rally. Some strong bank earnings set futures higher, and optimism was compounded by the 8:30 news of a healthy bounce in September retail sales. The S&P 500 opened higher and rallied to its 0.78% high about 50 minutes into the session. The index then sold off to a lunch hour low, erasing the morning's advance. Yellen's 1:30 speech did not renew the rally. The 500 traded sideways in a narrow range and ended the session flat, up 0.02% to 2 decimal places. The yield on the 10-year note closed at 1.80%, up 5 basis points from the prior close. The early stock bounce did indeed fade. The bond yield continues to climb, so does the dollar. The stock bounce fades as yields continue to rise. A morning bounce in stocks faded by the end of the day. The chart shows the S&P 500 ended the day at its low. That keeps stocks in a short-term downside correction and well below the falling 50-day moving average. It also leaves open the possibility that the September low could still be retested. Rising bond yields continue to weigh on stocks. The chart shows the 10-year Treasury yield ended the week on a stronger note after bouncing off its 200-day moving average. That pushed bond prices lower again. The jump in yields pushed utilities lower while supporting financials. Rising Treasury yields continue to push the dollar higher. The chart shows the U.S. dollar index, UUP, ending the week at a 7-week closing high. That's also weighing in large cap stocks. And I think that's it for the morning reading. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:17 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 17th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into our morning report. And at the time of this cut, all four of the broad-based U.S. indices were down, though relatively mildly. The S&P futures and the Russell futures were down just below scratch. Nasdaq futures are down about 0.25%. Dow futures were down just below scratch. Crude oil's up not quite 0.25%. Euro's up just above scratch, as is the long bond. Gold is down just below scratch. In terms of overseas action, China is down about 0.75%. Hong Kong's down a bit more than that. Japan's up about 0.25%. Germany is down a little more than 0.25%. The United Kingdom is down about 0.2%. So we'll continue to watch Europe for our open today. But so far, they're relatively negative and more negative than the United States. In terms of macroeconomic reports that are important to the United States trading market today, you have FOMC member Fisher speaking. You have the Empire State Manufacturing Index, cap utilization rate, industrial production. Also, I'll mention you have ECB President Draghi speaking. That could definitely be a market mover for us as well. And looking forward to tomorrow, you have CPI. And that's the only thing I see of note for tomorrow. In terms of current volatility, short-term VIX 12.94, so still relatively low. Skew still below 125, so relatively benign. IV percentiles have been climbing, but they're still relatively low. And you notice they're still all in the red. That's showing that they're in the lower third of the range for the 52 weeks. The S&P is at 32, the Russell's at 32, the Nasdaq's at 26, and the Dow is a 30. No standard deviation moves have been put in fact, for the last 3 trading sessions on a close-to-close basis. Let's go ahead and go to the charts. And here's our S&P action. And you notice here, look at this. We've got some tall wicks going both directions. The last 3 trading sessions. This is Thursday. This one's Friday. And this is the Sunday overnight into Monday morning. So while we are currently a little weak, we're not as weak as we were. We were down in the overnight as low as about 21.15 and change. The action, as we look at this, obviously, let's keep this all in context. You know, we've been in a big sideways consolidation action. We did have the break of diagonal support earlier in the week, and then that was then followed by largely indecision. And this action, while probing up and down, hasn't really been able to, in any significant way, confirm this breakdown, other than just kind of staying down there. We are also in the cloud still, haven't broken down below the cloud. We also haven't broken down below this area of former resistance turn support now. But all in all, this continues to have a posture of sideways to down. And you just, as you look at this, along with the other indicators and the other markets and so forth, you continue to believe that we're eventually going to break down and then probably go down and start to test these prior lows. Now, whether we do that or not, you know, it would then be a question of time. And as choppy as we have been, it's probably not going to be as clean a breakdown as we many times will expect. And we probably also will have to experience some false rallies and some false breakdowns before we actually see that breakdown. Now, all that could change, obviously, if we find some trigger for energy and momentum to be able to break us out of this consolidation pattern, then, you know, obviously off you go with that energy. But right now, this continues to look as a further slow deterioration. Most of the intraday rallies have really only been met by covering, and as soon as that kind of short-term trading is over, everybody kind of seems to be back where they started from. So this is very, very short-term trading. Certainly not a lot of institutional positioning in front of this. And whether it's the election, one of the morning authors mentioned the election, or it's other factors, it would start to seem that the polls are starting to widen and that the outcome of the election would be more understood. But obviously, the election is bigger than just the president's election. There's also the standing in the Senate and, of course, the House. And if the election were to move even a few more percentage points, it could call into question, what would the leadership of those two institutions be? And that could be weighing on current levels of investment, and certainly very few people willing to take a move in front of this. They're probably also remembering Brexit, where all the polls were saying one thing and then they got a big surprise and were caught kind of flat-footed. So a lot of things kind of going on in the backgrounds here. And what we tend to do is we tend to be, as technical analysts, we focus on the price action and see what it tells us. Well, right now the price action is decidedly neutral, and the same thing with the Dow. While this consolidation continues to kind of move towards the bearish side, it hasn't actually broken down yet. So there is still this possibility, though it does seem to be in probability terms starting to drop in the level of probabilities, that the bulls could come in here and then rally this thing up and take us up to the former highs. That is still in the cards. We have not deteriorated to the point where that can't happen. That's still absolutely in the cards, but yet at the same time, this is decidedly looking more and more neutral to bearish. Now, one of the things that kind of is holding things up is the relative strength of the tech sector, and especially in the Nasdaq, we see, we're really just barely below the all-time highs in the Nasdaq. So while you could make a case that the S&P and the Russell even, and certainly the Dow look to be breaking down, the Nasdaq is not particularly paying attention. Yes, we're down from where we were a week ago, but yet at the same time, this is just right now it's just a bull flag formation, and really no reason to say there is anything else. So the Nasdaq is not particularly paying attention to the weakness of the other groups. Now, we mentioned the Russell, and the Russell has been deteriorating. Now, it had been holding up better, but you see it's down well into the cloud now, down towards these prior swing lows, and heading towards what would seem to be, joining, and you look at this, basically a many times touch support area is where you are with the Russell right now. So could see a bit of an intraday bounce or a short-term bounce coming up off of this, but you just continue to have the feel that this is going to break down, and then once that breaks down, could very easily fall into this 1130 down to even 1080 area, especially if you see that the Dow and the S&P are already leading the way down. The Russell could be very quickly joining forces. So you've got 3 of the 4 indices that looked decidedly sideways to bearish, and at the same time, the Nasdaq, clearly, you have to put it in a separate box. Can it continue to hold that? That'll be part of the question. Now, crude oil, of course, had this important break and then has been trading in a very narrow range between the prior 52-week high area and the resistance now turned support. So also another market in a decidedly neutral range, though in a much more bullish posture that could actually be weighing against our S&P as the cost of energy starts to climb. In terms of gold, in terms of looking towards areas which might be, safe haven status, it's hard to argue that anybody's looking at gold as a safe haven status right now. It clearly has a significant breakdown. And just as in a consolidation after that breakdown at this point, we'll have to see how that responds should the market start to actually make a trending move. Now that trending move may take, the election. We could be in a sideways chop for another couple weeks until at least people start to feel like they know which way the election is going to go. In terms of bonds, the other safe haven status is long bond. That also is decidedly bearish. So this could be the start of the big unwind. And with the big unwind and yields going up, the value of your bonds go down. And we're starting to see in this whole series of lower lows and lower highs coming into place with the bonds. So now, if we truly need a safe haven status, money will flow back into the long bonds, but it won't flow back into the long bonds in any significant way unless people are truly fearful. And when you look at VIX, well, yeah, a little elevated compared to where we were, but it's still in the overall bullish range. We still think of everything between 12 and 18 as kind of the range of bull markets. And right now, we're just kind of in the upper edge of that. But certainly, the one time we poked our head above 18 recently, only took one session before that was alleviated. So while we're starting to see things start to elevate a little bit more volatility coming in, you could argue that we're about to have a cloud breakout. You're still in a situation where the volatility has not yet signaled that it is breaking. Okay, let's go ahead and go to the daily report. And we do have some important changes here today, not so much in the very top here as further down. We still believe that we are market phase 5. The break of diagonal support will start to look to see if we get a break of horizontal support across those important indexes as well. But certainly this process has been validated thus far. In terms of the 3 market timing signals, we're decidedly becoming weaker and weaker. First of all, from the IBD, the uptrend under pressure is our first warning level of a deteriorating condition. GMI index, very weak, 1 out of 6 and a 2 out of 8 on the GMI2. Sell signal, outright sell signal has been in place since 10/12, so quite bearish there. And then if we look at stock charts decision point scoreboard, I want to be careful not to make too much of this in that these signals have been flip-flopping back and forth like a big fish on the deck. And yet at the same time, you have to also recognize that with Friday's new signals, you start to look here, the short to intermediate term, short to intermediate term, the short to intermediate term, as we go across, the S&P 500, the 100, and then the Dow. Well, we often talk about looking for the stack. Well, the stack is starting to look far more likely to be a bear stack, and having all of our signals be neutral to bearish across 3 of the 4 markets. Remember, the Nasdaq chart was relatively far stronger, but even in the Nasdaq, you have the short term neutral to bearish and the long term decidedly mixed. So the probabilities of seeing a stack anytime soon are starting to seem to say that it would be to the bear side. So this overall bias of these 3 market timing signals at this point have to be clearly this neutral to bearish and this bearish. And we talk about change and rate of change. The change in rate of change is starting to point more and more to a bear signal on the market timing signals. In terms of position sizing opinions, they're still at 50% for the portfolio investor and for the volatility active trader at 75%, though these numbers could drop quickly should we have a break. In terms of intermediate term market posture, this is also becoming decidedly weaker. And if we go to a 20, then our hedge risk level is going to go up dramatically. Right now, we're in strong bear in 3 of the 4 indices. The S&P is our primary signal, strong bear signal with a weak bear sentiment line. And these numbers are starting to get relatively low here, so we have to pay more and more attention to the strength of this bearish intermediate term market posture. Even the Nasdaq on the intermediate term has now gone to weak bear, and if it drops below 50, it will also join the others as a strong bear in the intermediate term. The strength of this trend, you see, has been weakening for several weeks now. It's still up over 80. That would give us a bullish strength of trend, but certainly clearly weakening. We have, very importantly, I will mention on the hedge warning status, we have jumped from level 1 to level 2. Level 2 is a very, very important level. We call it the red light. I had kind of an internal debate over the weekend as to whether to make this a 1+, which would have been caution with, some significant concerns, but also level 2, I think ultimately was the place to go. I was looking at these scores right here. I'm supposed to be, when I get to a 20, I'm supposed to be at level 3. And, we could be literally just a few days away from level 3. I generally try to be a little bit quick, not a little bit late in terms of increasing the hedge warning level, rather to have, the action steps that you take as you come into each of these levels, called for, check your portfolio, beta weight your deltas of your portfolio that is not already hedged, and start taking a look at, maybe taking some profits on, especially anything that's a bullish swing trade probably needs to be very, very carefully looked at. Start taking a look at potentially putting on covered calls on some of your positions, on all the various other things that you do as the hedge warning status increases. Well, when you look at what we're getting up here at the top and these kinds of signals here and how close we're getting to a stack to the bear side, when you look at the intermediate term market posture, it was very difficult to justify just simply elevating to a level 1+, and decided to go all the way to a level 2. As such, in the strategy opinions, while the VIX is still inside the acceptable window, and indeed this level 2 may be a little different than many of our level 2s where we see things deteriorate rather quickly, this one might spread out over a period of time as we chop around, perhaps all the way up to the election before we start to see any significant move out of this consolidation. But overall conditions are borderline acceptable to initiate a new option income position for a novice trader. So just kind of keep that overall context in mind. Cover call strategies and put selling conditions are not acceptable for new positions for novice traders. More aggressive traders, of course, might want to take advantage of increasing premiums that are available. But consider all the various structures that we talk about on a regular basis for when you need to be more defensive in your orientation if you're going to take those positions. In terms of current warning signs, this was one of those things that made me think about perhaps leaving it at a 1+. There's not as much red here as we usually see when we go to level 2. And, hence part of my consternation about whether I should be 1+ or a 2. This distribution day count is really quite high. The S&P at an 8 now, and certainly once you get to a 10, most of the time when you're at a distribution day count of a 10, you are in a solid 2 or even 3 on your hedge risk level. The VIX phase has been increasing, but other than that, from a volatility standpoint, we're mostly kind of normal ranges, albeit perhaps normal to the higher edge of that window, but still very few of these have actually gone into warning status at this point. So that's something that kind of makes me think that this might chop around a bit longer before ultimately potentially breaking down. Also in the trend base, you have a couple signals here that are of importance. New York Stock Exchange on Friday was relatively benign. The intermarket risk aversion indicators have been increasingly turning down. We now have 3 of those signals as risk off. Sentiment relatively benign, though the fear and greed index has been ticking a little lower, and you see in recent sessions a 36 and a 40. So starting to tick down into this fear area on the fear and greed index. In terms of the current performance by sector, and this was for Friday, you see the groups. You know what? This doesn't seem to jive. It says Friday, and I pulled it up over the weekend, but the numbers don't seem to jive with the other data. So I'm going to skip that. And I'm not going to take the time to go check things right now, but I had the one report showing, utilities was the leader. I guess that was for the week. That's what's confusing me. Okay, so indeed, financials, XLK and XLB were the strongest sectors for the day, while utilities was for the week. And you see here, utilities at a 1.33%. So, okay, never mind. Sorry about that. Bottom line, in terms of Friday only performance, you have information tech, financials, materials, pretty good breadth on most of these are risk on kind of sectors, and yet the risk off sectors, largely negative and with greater breadth to the negative side. And at the same time, if you look at, who performed for the week, well, the performance for the week was real estate, utilities, consumer staples were the ones that were positive, also telecom. So the telecom and the other conservative sectors were the ones that performed for the week, though they gave back some of that performance on Friday. So the yin and yang of each day. I will also note here on the sector specific market posture, look at the short to intermediate term, not a blue, not a green to be found. Also, further deterioration that seems to be showing up across all sectors in this particular set of indicators. Okay, we've gone quite long today. We're going to go ahead and wrap this thing up. Pretty important session today as the hedge risk level goes up, and a lot of interesting stuff from our morning reading authors over the weekend. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the full set of disclosures may be found at this hyperlink down here at the bottom. We'll be back here tomorrow with our Falcon Global Market Preview. In the meantime, manage that risk. That is increasingly important. It's always important, but especially when you start to see your hedge risk levels go up from not just a 1, but now to a 2, managing your risk profile is absolutely essential to your performance.